I'm here in Shanghai, and today we're talking about why billionaire hedge fund manager David Tepper says it's time to buy everything in China. Tepper recently pointed out that with China's latest round of economic stimulus, Chinese stocks are trading at low price-to-earning ratios, creating some amazing opportunities for investors. He's bullish on companies like Alibaba, Baidu, and PDD Holdings, and he's particularly excited about China's support for stock buybacks. I'm Dan Beech with Simple Wealth, and today I'm in the Shanghai Financial District, Lujiazui, the Wall Street of China. Behind me is the Shanghai World Financial Center. Here, in only 11 square miles, are over 400 banks and financial institutions, corporate offices for over 70 international giants, and over 5,000 companies somehow related to investing. So I was getting the question, how would I even make an investment in a Chinese stock? First, let's talk about stock exchanges. In the US, we're used to the NYSE and NASDAQ. In China, the two main exchanges are the SSE, Shanghai Stock Exchange, and the SCSE, Shenzhen Stock Exchange. One major difference is the role of government regulation in China, where the government often intervenes to guide economic outcomes. This creates both opportunities and risks for investors. This is what David Tepper is talking about. Now, when investing in China, understanding the different share classes is key, particularly A shares and B shares. A shares are stocks of Chinese companies denominated in yuan. These A shares represent the largest and most liquid part of the Chinese stock market, often including companies like Alibaba, Baidu, ICBC, PetroChina, and Ping An Insurance. Historically, only mainland China investors could access these A shares, but now there are a couple of mechanisms to facilitate trading. If you're an institutional trader, 10 billion or more, there's a special program called Qualified Foreign Institutional Investor, QFII. For most of us, we'd be using the Stock Connect system put in place in 2014. It can be a bit nuanced, but think of this as basically routing your trades through Hong Kong first. With these A shares trading in the yuan, you're adding an element of currency fluctuation risk. B shares, on the other hand, are traded in foreign currencies, US dollars for Shanghai B shares and Hong Kong dollars for Shenzhen B shares. These were originally designed to give foreign investors easier access to Chinese markets without dealing with yuan. The risk here, B shares are less liquid than A shares, so you could end up in a situation where you want to sell, but there isn't a buyer in your currency, but there's still a viable option for international investors looking for exposure to Chinese companies. For US-based investors who want to avoid the complexities of investing directly in China, ADRs, or American Depository Receipts, are another option. ADRs allow you to buy shares of Chinese companies like Alibaba, JD, or Baidu directly on US exchanges. You get exposure to Chinese growth, as David Tepper is telling us, without having to deal with currency issues or the Chinese market's regulatory framework. It's a simpler way to access these companies, many of which are smaller in market cap compared to their US counterparts. They can still represent key opportunities in fast-growing sectors. How do these Chinese firms compare with the names we're used to in America? In the US, we've got massive players like Apple, Amazon, Microsoft. Each of these companies has market caps over $1 trillion. These are some of the largest corporations in the world, and they dominate global markets. In China, the biggest companies are also giants, but tend to be concentrated in tech, finance, and state-owned enterprises. Alibaba is about $241 billion, Tencent $509 billion, The leading 4 Chinese companies are the Forbes Global 2000 ranking in 2024 are all from the financial sector. Companies like China Mobile and ICBC, the Industrial and Commercial Bank of China, which are both state-owned, dominate in sectors like telecommunications and banking, but with market caps closer to 150 to the 300 billion range. Before I go, just some cool comments about architecture. There's over 100 high-rises in this financial district, but the standouts are Shanghai Tower, tallest building in China, at 2,073 feet tall. Then there's the Shanghai World Financial Center with 101 stories. And we can't leave out the Oriental Pearl Tower, overlooking the river and the entire city of 25 million people. If you're interested in learning more about how to get started or what makes sense for your portfolio, follow us for more.